mute everyone? No, actually, I think it's the mark. If you would have to set the settings so that everybody shows up muted. Whatever, it's not a big deal. Anyways, let me see. Portugal's Cristiano Ronaldo offered his hotels in Portugal for hospital overflow to quarantine. That's excellent. There have been a lot of people who've done some really good things. I'm really happy to see it. We've seen even NBA players, for instance. There was an NBA player in the South who offered to pay salaries for all of the people at the convention center who wouldn't be working this month. And I was like, oh, that's pretty impressive. So there's a lot of people who are trying to do good things, and the more we can do together, the best. The better off we're ultimately going to be. So Lauren mentioned that Top Hat just offered free services. That's excellent. Data overage fees have been reduced. But Ajay asked, where does the Toronto Canadian housing market stand? One thing I can say in that area, I was looking at a Facebook group the other day that is all Airbnb not renters, but site facilitators in Toronto. So people who bought places and are turned them into Airbnbs in Toronto. And someone posted the point that they had 4 apartments that they had bought specifically for this. They quit their jobs to run Airbnbs full time, and that they were losing their minds because their occupancy rates have plummeted. That's going to be one of the fallouts from a decline in tourism, unfortunately, is that people who took these really sort of leveraged bets, especially by taking 4 mortgages, are going to find themselves taking quite the hit. Kyle, shut your mic. So, a couple of interesting sorts of things. Eros says there is circulating news that we're going to face recession. I'm happy to comment on that. In my opinion, I think we are most certainly staring down the barrel of a recession. Kyle, turn your mic off. Mark, can you mute Kyle? Just because I'm getting a lot of static and stuff from his mic. I can't do anything about it. Anyway. So in terms of a recession, one of the big things to look at is not so much just what the impact of COVID is going to be, so much as what was the situation around the world before COVID struck. In my opinion, we were looking at a very sort of sketchy situation around most of the world. My assessment for the last year or so has been that there is a very high probability of a economic slowdown. Unfortunately, Kyle, off your mic. I think what we're likely to see is that it's going to be really hard for us to avoid falling into a recession at this point. If we take a look at the US has been trudging along pretty well, you might argue, but since September, there have been some complications in what's called the repo market that has forced the central bank to reactivate providing emergency liquidity. And what they thought was going to be a short-lived program in September and October of sort of providing a little bit of pavement for the repo market is turning out to be something much, much more substantial. And it seems to be continuing still 6 months later. We've also seen the Fed step up with an enormous liquidity injection to try to prevent the kind of disruptions that we saw in 2008. Repo market, Miriam, is a way of, okay, we got to do something about those live mics. It's really hard. Okay, the repo market basically involves central banks offering emergency liquidity by being willing to borrow government securities from the banks overnight at particular rates. Normally, the banks lend to each other in the overnight market using government securities as collateral, but they found in September there was an insufficient amount of liquidity being provided by the big 4 banks in the US, and so the Fed itself stepped in to try to provide some of that liquidity. So I think that there's continuing sort of weakness underlying what seems to be like very strong US success. So taking a look around at the rest of things, the US has been going through a particularly long expansion. Stock prices are particularly high. The biggest thing that's missing when we take a look at the Federal Reserve Open Market Committee meetings is inflation. They've seen all kinds of signs about sort of the end of long-term business cycle. And it's not just a matter of flattening yield curves. They've seen several indications of it. But the big thing that keeps coming up at the FOMC meetings, the Federal Open Market Committee, is that they just don't see inflation. They don't see a lot of price pressure yet. Part of the reason for that macroeconomic puzzle that was troubling the Fed a few months ago is that America still has a lot of discouraged workers who are coming back into the workforce. So they've been able to reactivate a lot of people. Traditionally, when unemployment is low, it means that it's relatively easy for workers to bargain for higher wages. But the problem is that the unemployment numbers do not actually reflect how many people are out of work. Unemployment numbers reflect people who are out of work and are actively looking for work. And that means that if you've become discouraged or you've stopped looking for work, you don't count in the unemployment numbers, which means that there's actually a lot of hidden slack capacity to put people to work in America, which is one of the reasons we haven't seen that sort of inflationary pressure yet. But many of the other things that we would expect to see at the top of the business cycle have been present. In Canada, our situation is even riskier.
Yeah.
Major concern in Canada is that we have two major industries that have been driving wealth creation in the country over the last several years. Thank you, Kyle. One of the big problems that we faced, it was sort of the derailing of our energy industry to some extent. And the biggest problem, although you'll hear a lot of different people talking about what the causes are, in my opinion, the number one cause of the problems in our energy industry have not been a lack of pipeline infrastructure, though I'm sure that contributes. It's the simple fact that it's cheaper to frack. It's cheaper to frack in the United States. That's exactly what we're doing. And most of our export capacity goes straight to the United States, where they have refineries to process bitumen. On top of that, the pipelines that we need to be able to export stuff from Alberta happen to dump into North Dakota, which has a really oversaturated market for its own oil production. So there was already a difficult time ahead for Alberta's oil economy, which is witnessed in the high unemployment rates that we see there, even just in the fall. Alberta was already hurting. The Saudi-Russian price war is going to make things that much worse. So Canada being able to rely on the oil industry is about...
flight.
So I think that that's going to be...
enjoy inshallah.
I think it's about to become even more challenging for Alberta than it was before. Now, the next big problem that we run into in Canada is where the other engine of growth has been, and this has been housing construction. If you take a look at national accounts over the last 10 years, we've seen the wealth of the aggregate household sector in Canada go from $6.5 trillion to $11.5 trillion. And the majority of those increases, when we look at national accounts, has been in land and residential housing. Most international organizations, from the Bank of International Settlements through to the IMF, believe that there was a housing market bubble in Canada. I don't care what Brad Lamb says about, oh, it's the Greenbelt, oh, there's all these people moving in, oh, there's all this condo construction. Prices of real estate in Canada have gone out of control to a large extent. Workers cannot afford places to live. The number of hours that a worker needs to conduct in order just to be able to afford their place is astonishing. And we've actually seen the rise in housing prices starting to cap off in Toronto. If you take a look at Terranet, which is the National Bank of Canada's sort of housing price index, you'll see that the rate of price increases has been slowing down. This sort of indicates that we're getting near the top, that people simply cannot afford to pay more. And another thing that's worth noting about Canada's housing bubble is that where the money comes from for the bubble. A lot of people tended to think over the last couple of years that it was foreign demand that was pushing prices up faster than usual. One of the things I would point out is that in order to get a mortgage in Canada, you have to borrow it from somebody. So there's got to be money somewhere in the system in order for you to borrow it. Canadian banks have currently got over $1 trillion borrowed from the US financial system in the last 3 years that they've been pumping into our housing market. So Canadian savings have not been going to prop up our housing market. Literally borrowing from quantitative easing in America has been propping up our housing market. So this creates a really serious concern. Yeah, a lot of the foreign pressure is cash-based. Quite honestly, it's a totally different discussion. It's money getting out of China. right? You too would diversify. If your home economy was slowing down, there were fewer opportunities for amazing growth, you would diversify and buy property in the kind of places that necessarily have better rule of law. We saw the same sort of thing happen with Russians buying properties in London in the early 1990s after the Soviet Union collapsed. It's wealthy people being clever and diversifying their portfolios. Yes, it did push housing prices up, but one of the major concerns is that the housing prices have risen too fast. This has created a big boom for the construction industry, but unless we can sustain that kind of money coming into the system, construction is going to slow down. So the real implication here is what happens to Canada's economy when the oil economy stops producing so much profits, and what happens to Canada's economy when housing construction slows down, as we pretty much should expect it to if we stop borrowing from the States. So in that sense, Canada is basically staring down the barrel of a recession. Thankfully, our central bank hasn't been as aggressive in cutting interest rates as the central bank in the States has. We haven't felt as much reason to. So we still have a little bit more dry powder. We don't have a leader who is pressing our central bank to prop up the stock market by cutting interest rates. So we've got a little bit more dry ammunition to deal with this sort of situation than the Americans do. Nonetheless, I would expect between the combination of less tourism, which is definitely going to have an impact on us over the summer, when people are normally getting ready to travel, combined with damage done to retail and any sort of service industries, including things like restaurants, you start to put all these pieces together, and it's really hard to see where economic growth is going to come from in Canada. Now, in order for us to fall into a recession, what we technically require is 2 consecutive quarters of negative GDP growth, which basically means the economy has to shrink consistently over the next 6 months. A recession won't get triggered tomorrow. Nobody's going to announce that we're in a recession. Even if you look at Steve Mnuchin, who's the US Treasury Secretary, he says, I don't think it's likely that there will be a recession, because in order for there to be a technical recession, you need 6 months of declining economic activity. And at this point, it's not sure whether we're going to see a long, deep slump or we're going to see a fast V. Now, here's where a little bit of historical perspective, I think, is valuable. Take a look at the 2008 financial crisis. We also had a sharp V in economic activity. There was a serious decline in fourth quarter 2008 when the banks stopped lending to each other internationally for a short period of time because they were still sorting out who was riskier than who. It meant that international transactions ground to a halt to some extent. As a result of the problems in the banking system for a month or two, for basically the whole quarter, it resulted in a serious economic impact in the real economy. And there were about 30 million people around the world, 20 million of them in China, who lost their jobs in fourth quarter 2008. So even though this was a sort of a heart attack on the financial system and no factories burned, no people died, it still created a massive disjoint that took us years to overcome. So I suspect that we're likely to see a similar kind of problem. If you would have asked 2 or 3 months ago whether America was going to shut itself down for a few weeks, the answer, of course, would have been no, definitely no. Today, it's not quite so clear, and there's a lot of indications that that sort of thing could happen. Now, if you shut down the world's biggest consumer market, or even slow it down for a month, it's going to create major problems everywhere. So I suspect we're likely to see the same sort of heart attack that we had in the 2008 crisis, where we had sort of a quick, sharp disjoint in what happened, but there were second and third order effects which persisted in some cases for years afterwards. If you don't believe me, just ask the people in Greece or the people in Italy or the people in Spain how long the financial crisis went on for. For us, we could be like, oh, it was short and quick. Within a couple of years, things were fine in Canada. 10 years later, the Greeks, the Portuguese, the Italians were all still struggling with the economic fallout. Even in places like China, where we saw a relatively robust recovery and we saw continued economic growth, this all happened as a result of massive continued government stimulus and a huge increase in local government debts, which the Chinese government has been trying to unwind and limit and deleverage their whole economy for the last few years because they recognize the inherent dangers of it. So yes, in the short term, we can solve some of these problems by putting big band-aids on it, but there are real structural problems underneath in some cases, which are simply revealed by these kinds of crises. And I think we're about to find out that Canada has been flying on one engine, and we're about to be drifting for a little while until something can restart. What does that mean from a financial perspective? Well, I would say there are certain sectors like healthcare, which will boom. There are certain sectors like IT, as we mentioned earlier, companies like Zoom are going to do fine. I think that certain industries are going to do disastrously bad. That said, not everything's going to collapse. We have seen indications from companies like WestJet that they're talking about enormous layoffs, which is, of course, going to have a big impact. And I think that as retailers, as tourism industries, as airlines start laying people off, that those people are going to necessarily cut back on their own consumption, and that in itself will help to spark a recession. So before I start giving ideas of what we can do with this or some of the second and third order effects, let me have a quick run through the chat because I haven't been following that clearly. I'm glad we got the muting problem solved. Okay, Adrian asks, based on the recent injection of cash back into the market, how will this affect inflation? It's going to take a little while for that money to transmit through. I would argue that an injection of money does not automatically cause short-term inflation. Quantitative easing was an injection of money, but it mostly ended up in real estate and stock markets, not necessarily in wages. And normally what drives inflation is either wages or energy costs. At least that's what the major drivers have been of inflation over the last 30, 40 years, since governments started moving towards inflation targeting as monetary policy, instead of taking the Keynesian approach of just turning on the government money tap every time there's a problem in the economy. Well, let me see, what else is there? It's haunted by a ghost. That's true. Okay, assuming there will be a worldwide recession, what indicators should we look into to know when the economy is recovering? A useful doc that I can actually, maybe I can just post here for everyone. I mentioned it to my class the other day, is the OECD's, the Organization of Economic Cooperation and Development, provides a document on leading economic indicators that are different in every country. So let me see if I can dig that up really quickly for you guys. It not only provides the information of who or of what indicators are deemed to work in each country, but it also gives us some idea of where to get that information. Now, for those of you who don't want to get that much into detail of digging up information from all these countries, here's what they call a composite of leading indicators, courtesy of the OECD. Now, the one I just posted there is looking at the entire OECD, but it gives you some idea about what our economic indicators look like. And if you have a look, the last time our economic indicators were in a similar type of situation, we were looking at the Greek crisis in 2012, 2013. So things do not look great, to say the least. In China, growth is slowing down. In Japan, the Abenomics seem to be turning the corner, but their customers are Europe, America, and China. So without demand there, the Japanese have nowhere to grow into. In Europe, growth is going to be stilted. The Germans are in a contraction. Britain's in a contraction. The Netherlands will be contracting soon enough. Italy has been shrinking in terms of population and GDP since 2005, 2007. So Europe is not going to spring to life. And if we're going to see any sort of recovery, I expect that it will come out of, ideally, consumer demand from America. The big problem with that is that America seems to be slow to their response. I'm not sure whether this is governments trying to signal that everything is okay, don't panic while they quietly arrange for things. But I suspect it's a little bit more like the Chinese government's response in December when they knew that they had a problem on their hands, but they didn't want to signal to other people that there was a problem. Whether this was a matter of national pride or trying to prevent a panic among people, either hypothesis would make sense and either hypothesis would seem reasonable from the government's perspective. Nonetheless, the US has been slow in getting to the kinds of response that it probably should have had earlier. And so I suspect what we're going to see is it's going to take a little while for America to generate more demand that could help places like Japan or China or Germany recover. But if America stops buying, everybody else falls into a recession. That's the general rule. The old sort of joke in macroeconomics used to be that if America catches a cold, the whole world gets sick. No pun intended. That sort of thing is going to be happening again. Okay, here's that leading indicators link. I realized I sent it to the wrong person. I'm not very good with this stuff. Okay, let me see. What else we got in the chat menu? Allison asks, do you think that this will affect private lenders? I have a second mortgage on our house and it's private. Our mortgage broker is losing her mind. Scotia has been great. Private lenders are likely to be a lot more sensitive to this than a bank which has a lot more resiliency and in general, deeper equity pockets to be able to absorb individual losses. Private lenders are generally not as diversified as large institutions are, so they are most definitely feeling the crunch. They have a need for liquidity that they can't tap into central banks. If TD has a shortage of cash, it can tap the Bank of Canada. If the Bank of Canada has a shortage of cash, it can literally print up more money. Private lenders don't have that option. So when they feel the crunch, they're going to respond in a serious way. I expect the private mortgage market to dry up dramatically. I wouldn't say entirely, but I expect there to see higher rates from private lenders over the next couple of months as they're just not able to tap their liquidity facilities in the same way. Now, that said, they may be able to borrow from expanded liquidity through banks, but I still expect that in general, all lenders are going to experience what we call a flight to quality. The general rule when there's any kind of economic crisis is that everybody gets scared. And when everybody gets scared, they effectively turn what we call risk off, which means they're not interested in chasing higher yield. They just want security. They want capital preservation. They're not looking for growth. They just want to lock in the gains they've made, which means they're not going to be interested in making 7, 8, 9, 10% second mortgage loans to people, simply on the basis that there's uncertainty as to whether or not people will be able to pay. Because if that second mortgage isn't getting paid, there's going to be a serious disruption at the lender. So that would be my concern. When risk off happens, there are some immediate reactions in the market. Even though the US may not be very well equipped to deal with a massive public health crisis like this in the short term, in general, people will flood the American markets. They will move to US government treasuries exactly like they did in 2008. Even though 2008 was basically caused by or centered in the United States, what we saw is that the value of the US dollar actually rose as everybody pulled their money out of emerging markets, pulled their money out of the stock market, and just plowed it into government treasuries. So I expect that there's not a lot of room for government treasuries to move at this point, but I do expect that any sort of risky market is going to see major contractions, everything from the stock market to secondary lending, et cetera. I think a lot of people are going to be unwinding the enormous amounts of margin loans that they have. I think a lot of people probably got their ass kicked with a lot of their margin lending in the last couple of weeks. There are still very, very high amounts of margin loans out there in the market. So I would have big concerns about people unwinding that. And that means continued selling pressure in the market, despite the central bank effectively turning on the fire hose to try to prevent panic selling. I don't think they're going to be able to stop it. But that's, again, my personal opinion. Maybe they will impress me. We'll see. I'm not entirely clear on the notion that the Fed can save the day. I don't think they have enough ammunition to do this, and I don't think that monetary policy is going to save us from this particular problem. How will it affect our dollar? I suspect the Canadian dollar will fall against the US dollar simply due to a flight to quality. People are going to look at investment. If I'm an American and I look at investments in Canada, I say, okay, that's all finance and natural resources. Commodity prices will drop if there's a recession. Oil prices are already down because of the Saudi-Russian oil price war. Therefore, Canada is just not a particularly attractive investment to Americans right now. I suspect they're going to pull their money out. The thing that worries me would be if there is a freeze up in the financial system in the United States, that they decide to start calling some of those loans or refusing to roll over loans from Canadian financial institutions. I don't suspect that's going to happen, but that would trigger a major crisis if it did. Otherwise, I would expect to see our dollar drift probably into the range of about 70 cents. I don't think it's going to collapse to 50 or 60 cents. I think that's preposterous. But certainly we could see 3 to 5% downside on the Canadian dollar compared to where it is now. Keep in mind that this is not necessarily our dollar dropping so much as the American dollar rising as people pull their money from everywhere else in the world and plow it back into the US. I said, can you explain the comparison between 2008 and 2020? Basically, I'm looking at serious disruptions that arise very quickly and people's panicky responses to it. One of the things we saw, for instance, in 2008 was a clear lack of ability to sell from where goods are being produced to where goods were ultimately being consumed when the banks stopped lending to each other temporarily. If you take a look, NASA has maps of various kinds of industrial pollutants that are published from satellite data. One of the most interesting things to look at is the NO2 maps, but I haven't seen a good update of it since the end of last month. So it's a couple of weeks out of date. And from what I understand, that Chinese factories are recovering rather quickly in terms of their output. The question is whether or not there will be people in America going to stores to buy stuff that the employees at those factories are making. On the plus side, one of the inadvertent consequences of the shutdown in China for a few weeks was that air quality indicators are pretty good right now. If we take a look at, say, February and March air quality indicators year over year in places like Beijing, Shanghai, Guangzhou, Shenzhen, what we find is that the air quality is actually a little bit better. The problem is the air quality is better because they shut down a bunch of the factories, which means I'm pretty sure people weren't getting paid. And it's, how do I say, 9 parts bad, 1 part good. But we can use those kinds of air quality indicators and NO2 maps to try to get an idea about how quickly things are recovering in China. Nonetheless, the point of making the 2008 comparison was to try to identify what the second and third order consequences are to having this kind of heart attack in the financial or production systems.
So, Will, would you say that there is a potential positive environmental impact then worldwide, given that we're all being forced into this sort of hibernation mode to prevent the spread of COVID? So basically, it's starting off with these factories being shut down in China temporarily. But given sort of this worldwide domino effect that's happening, I mean, it's not going to solve like the planet's problems of what we've done, but would it provide a little bit of relief in the meantime?
Absolutely. We're going to have a little bit less industrial pollution, a little bit less greenhouse gases emitted from all those flights that are being grounded, temporary. But yeah, exactly. I'm pretty sure that the people in Beijing really enjoyed the blue skies that they got in February as a result. There used to be this joke kind of came out of China about what they called APEC blue. And it was a weird sort of term that was meant to be something that is beautiful but temporary. So it was sort of poetic, but it was when the the Asia Pacific APEC conference happened in Beijing, I believe it was. They shut down all the factories for 2 weeks, and people had beautiful, clean air quality and blue skies. And the locals basically referred to it as APEC blue. It's beautiful, it's temporary, and it won't last. It's sort of, like the version of summer romance, effectively. But in the short term, yeah, we'll see a slightly decrease in the amount of greenhouse gases, but kind of cold comfort. It's, again, one of those 1 part good, 10 parts bad. So you had asked, what are the chances of witnessing a spike in interest rates? I would say we're going to see the exact opposite thing. We're going to see interest rates get cut. The Fed has a meeting on Wednesday, and a lot of market participants are expecting rates to get cut. I'm also expecting them to engage in a rate cut because why wouldn't you turn on the fire hose in a crisis? The big fear is what will come after the US has already dropped to 0%? What other monetary policy tools can there possibly be? I suspect what we're going to realize is that we need, once again, a combination of not just monetary policy, but also fiscal policy. So I would expect to see government spending around most of the world rise to try to boost that sort of aggregate demand a little bit and try to keep people at work. Like I said earlier, Trudeau even went out, had a press, spoke to the press and said that there was going to be relief, financial relief for Canadians who were in need because people shouldn't have to worry about paying their rent or whether they can feed their kids, etc. I would expect to see a fall in interest rates, a rise in government debt. That's what I genuinely expect to see. So how can we sort of position ourselves to take advantage of a fall in interest rates? Buy bonds. Buy long-term zero coupon government bonds. All the stuff you learn in I-6 or BL 601 about how bonds are affected by a change in interest rates, this is the time to take advantage of that. We are pretty sure there are rate cuts in the pipeline. Therefore, long-dated, currently low yield bonds with low coupon rates are going to see the biggest price changes. Right now, of course, everybody knows that. So there will be some anticipation in the market. You won't see a complete pop. It's not like nobody knows this. Every bond jockey in the world knows that's what happens when interest rates come down. But there's almost certainly going to be an opportunity to take advantage of some of that. It's probably useful to reallocate portfolios to some extent and look at the mix of industries you're invested in. Traditionally, during a recession, the first sorts of things to get cut is CapEx on tech. So tech is likely to face some challenging times ahead, Zoom aside, but tech as a whole, people making tech hardware are likely to face some challenges because businesses that don't have a lot of cash tend to cut the projects with the shortest lead times first. And technology rollouts often have short lead times. So the next thing to get hit is often construction. So there are cyclical and non-cyclical industries. And one of the other cyclical industries is what we call consumer discretionaries. If people feel poor, they don't buy new TVs, they don't buy new microwaves. But one of the things they do keep buying is toothpaste, toilet paper, tampons, electricity, medicine. So it's probably useful to shift your portfolio a little bit. I'm not talking about wholesale sell everything you own and buy other things. Shifting your portfolio like that has big costs, but a reallocation away from growth towards value is probably going to be useful. So traditional value sectors are things like defense, utilities, pharma, healthcare, consumer staples. That sort of stuff will not necessarily fail to lose money, but it will lose less than things like tech, construction, consumer discretionaries, jewelry, tourism, etc. Those are going to take a big hit. I would expect to see that hotels in particular have a really hard time this quarter as a result of this. Let me see what else I got in here. We got another 15 minutes before we got to call it a day. What factors do you think will hurt the Canadian big banks? High balance sheet on residential mortgages in the GTA and Vancouver that are subject to housing price bubbles and job loss in case of a recession. Yes. I tend to think Canadian banks are generally well insulated from financial crises. The reason we came through the 2008 financial crisis so well in Canada is because while we all bitch about paying the highest banking fees in the world, which we do, that creates a huge stable amount of fee income for the bank. So even when their income from the interest rate spread declines, even when their interest income is taking a hit in a recession, people are still getting screwed for $9 a month just to have a checking account, and that keeps the cash flow rolling at the big banks. So I think the big banks are in a pretty reasonable, safe position, and I typically put them in the recession-proof category. There's a lot less competition in Canadian banking, therefore the margins are a little bit thicker. Over the last 10 years, we saw several instances where the central bank cut interest rates and Canadian banks did not follow suit, which basically means that they got a wider margin between their funding costs and their lending, which has enabled them to build significantly thick profit margins. They haven't been excessive in making their dividend payments. They are very well capitalized. It would take a serious crisis to really impact Canadian banks. It would have to be worse than 2008, and I don't see indications that that's the case just yet. Should one be worried about access to funds like in Greece back then? Not right now. I wouldn't be concerned about that. The reason Greece had a problem with access to funds is because they were trapped in the euro and they weren't allowed to print up money as they needed to. Had they been allowed to just print up currency, they could have easily met their liquidity requirements. In fact, if you take a look at how the Target 2 system works for allocating cash between the central banks in the ECB system, even though there was money racing out of Greek banks, and being deposited in German banks. At the end of the day, the Germans lent that money back to the ECB lent that money back to the Bank of Greece, and the cash pretty much was available for people who needed to get money out in the long run. In the panic short run, could everybody cash out of the banking system? Of course not. There's a scene from It's a Wonderful Life, I believe it is, that Christmas, black and white Christmas movie, where it's really well explained why people can't all get their money out of the local credit union at the same time. It's because it's in people's mortgage, it's in people's student loans, it's tied up in human capital now. So that's sort of the reason for the panic that we saw in Greece with people lining up to get their cash out. But at the end of the day, I don't think that's going to be a major concern. Most of our transactions aren't with cash anyways. Most of your transactions are done electronically, and therefore it's irrelevant whether or not you can get cash. As long as you can access the electronic ledger, that's all that matters. Do I see a huge impact on luxury spending? Oh, hell yes. Yes, I think that's one of those things that people are going to be looking at very questionably. It's a consumer discretionary good. And rich people are going to feel this hit as much as the average working person is. Because the average working person, you have to remember, doesn't exactly have a stock portfolio that they're worried about. But the owners of LVMH most certainly do. The wealthy clients of these kinds of companies most certainly do have stock portfolios, and we'll get what we call in economics a wealth effect. People will automatically feel that because the stock prices are down 20, 25%, that they are suddenly much poorer. A lot of people are not as well diversified as they should be. They're focused on trying to grow their wealth, and as a result, they put way too much in stocks than they should, because they realize that that's where growth comes from, and they don't think during expansions about risk. They think about reward. So there is a well-documented effect that when stock markets fall, consumption falls, particularly among people with investments in the stock market. They will tend to just start buying less. It's the same thing that happens when housing prices crash. Housing prices crash, everybody that owns a house suddenly feels way poorer, and as a result, they stop going out to restaurants, they stop buying fancy jewelry and ordering fancy dresses and suits on the internet. So I definitely think that the big luxury brands are going to have a hard time with this. At least in the short term. If this turns into a recession, as I expect it to, it's going to be a hard year for LVMH. Long run, awesome buying opportunity, right? Every recession is a really good buying opportunity. Unless we think this is genuinely the Black Death and it's going to wipe out a massive number of people, this isn't going to affect a country's ability to generate long run aggregate supply. We still have energy resources. We still have people, we still have infrastructure, we still have factories. The world is not burning down at this point. What we have is a short-term sort of heart attack situation. It's not lethal, it's not going to destroy the global economy, but it is going to create a significant disruption in the short term. The real buying opportunity is not going to come because there has been an efficient reduction in prices. The buying opportunity is going to come from the panic that results. The idea that things are not under control, that we all need to sell our shares right now and cash out, that's going to create a self-fulfilling prophecy. In the same way that everybody thinking the stock market's going to go up makes the stock market go up. If everybody thinks it's going down, it's going to go down because they all start selling. That's an opportunity. That's how we should see this sort of thing. At the end of 2008, people were like, oh my God, the world is on fire. Yet in 2009, the Standard & Poor 500 returned a 50% return. By 2010, the end of 2010, 2011, so about 2 years after the crisis, any stock market losses had been almost entirely recovered. This is genuinely a buying opportunity. I don't know that like Monday's market open is the buying opportunity, but I would provide two historical quotes that I think are pretty useful from good old Nathan Rothschild in the early 19th century. So if I realize that's a logically an appeal to authority, but he did quite well for himself. So there might be a little bit of wisdom in his words. He said that the best time to buy is when there is blood in the streets. Now, hopefully people pulling guns on each other in grocery stores in Toronto does not actually result in blood in the streets. That crazy shit actually did happen the other day. It was weird. Somebody pulled a gun in a grocery store fighting over, I believe, toilet paper. Like, crazy. So hopefully no actual blood in the streets, but nonetheless, when there's enough fear, and that's a great buying opportunity. The other good quote from Nathan Rothschild is related to trying to catch the bottom of the market and why you should not do it. He says, the secret to my success is not buying when there's blood in the streets. He said the secret to his success is never trying to buy the bottom and always selling too early. People who want to hold out to the very top put themselves in dramatically risky situations, assuming that they can know when the crash is coming. The best thing to do is that when you start making good gains, focus on keeping those gains. Don't try to pretend that you're going to be able to call the top, and don't try to pretend you're going to be able to call the bottom. It's a risky, risky game. If you want to speculate, go right ahead. If you're talking about investing your life savings, I would encourage you to be cautious and to wait a little bit. That's sort of the best short-term advice I can give. Unless you are a relatively sophisticated financial operator, unless you got a good handle on macroeconomics, unless you want to watch the news every day and understand what all the central banks around the world are doing, in general, try to protect your wealth. Do not panic sell, do not panic buy necessarily, but try to take some steps that might allow you to preserve some capital. Shifting some of your asset allocation from riskier sectors to safer sectors is probably a smart idea. Owning some fixed income securities, probably a decent idea, especially this week with the coming rate cuts. But otherwise, I think that participating in a general panic is a bad idea, but the general panics can create opportunities for those people who have some nerve. All right, let me keep looking at these because I'm running out of time. I got about 5-10 minutes left. Mo asks, are your funds mostly liquid? Yes. Yes, as a matter of fact, I've been sitting in like 75-80% bond funds and fixed income for the last, and like money markets for the last almost year. If you would have asked me a year ago if I thought there was a recession coming, I would have said yes. Magically, it did not arrive. Perhaps not magically. I was probably just wrong about being Chicken Little and arriving too early to the party. But the fact is, at this point, I definitely think that we've got a recession in the pipeline, and it's to your advantage if you have funds on the sideline to start shopping for value opportunities in the next couple of weeks. Advice for people who still have money in stocks, wait it out. I'm not sure panic selling is all that useful. Do I expect to see further declines? Truth is yes. I would expect to see markets drop off another maybe 10% before we start seeing any sort of real bottom forming. The last couple of weeks have been carnage in the stock market. I think there's more to come. I think that the smart money moved fast, and I think that a lot of people who are sort of slow on the financial uptake woke up after this past week and realized that they were hugely exposed to this, and they've already lost 20-25%. The Johnny-come-latelys are usually what pushes a stock market bubble to the top, and they're also generally the people who push the market to the bottom. If you are at all savvy with this sort of stuff, the easier solution rather than selling your stocks would be to buy puts. Put options will be expensive right now, though, because volatility is so high. If you take a look at what's called the Volatility Index from the Chicago Board of Trade, or the VIX, it hasn't been this high in a decade. The only time we've seen the VIX be this high since they started publishing the VIX in the early 1990s was during the height of the 2008 financial crisis. It's generally regarded as the fear meter, and fear is really high. So option-based hedging is very expensive at this point in time. In general, short selling is a dangerous game. I like buying bank stocks. I like things that have high dividends. I like focusing on what I would consider to be value plays right now. But in terms of short selling, again, with the risky strategies, I would not advise average people to engage in short selling. I would not even advise people who've taken business degrees to engage in it. Fighting the central banks right now is a dangerous game. They still have some ammunition, and you may not be able to outmaneuver them. Be careful with short selling. Jason asks about my projections through the end of the year. I'm careful about making that. I would tend to think that the three scenarios that came out of that McKinsey report that was posted to the 2018 BL section identified three different scenarios. Their first scenario seemed quite rosy to me, that this would pass. And in the last week, we've seen some updates from the intensity of this in the States. And I think that their best case scenario is probably not going to come to pass. Their middle scenario of a decline in economic growth, where they expect U.S. economic growth to fall to maybe 0.5%, would be more realistic. But I would still put my money on recession. I would still put my money, maybe not even on a technical recession, but on a significant contraction of the economy. If GDP numbers were being published every month, we might see 3 or 4 months worth of declines. But technically, in order to hit a recession, you need to have 2 consecutive quarters, which is how Germany narrowly avoided it last year. They got a quarter of 0.1% growth. It's like a ball falling down a staircase, right? It's like the stock market. You'll see it go up and down as it's on its way declining. Okay, let me see what else. Do I see short-term recovery in the stock market after COVID-induced drops? Yes. I think we're going to regularly see bounces along the way. I think that before we recover from the economic impact of COVID, that the stock market will recover. Again, 2008 is my guideline. Long before the economic problems of 2008 were resolved, the stock market roared back to life. Like January 2019 was a fantastic time to buy the market, and all year long it roared to life, even though the economy was hurting. The stock market is generally a leading indicator for the overall macro economy. Do I have any leading indicators on the stock market? Let's just say if I had any that I could hand out, I would not hand them out. I'd open a hedge fund and charge you all 2 and 20. Now, what about those of us who are modest with our investments, RRSPs, and mutual funds? Veronica, I would encourage you to stay well diversified. I would focus on funds that generate yield, shift away from growth towards value. I'm not doing any sophisticated strategies myself. My portfolio is a globally diversified index fund is my baseline. I have a lot of money in diversified money market accounts, diversified bond funds right now, just trying to hold slightly higher than inflationary yields while I wait for buying opportunities. So I am also of modest portfolio allocation strategies. I could get complex, but I spend my time teaching instead of running my portfolio. So I've got some limits on it. In general, what do I think people ought to be doing this week? I think that people should probably be looking at what liquidity they have available. Interest rates are about to drop. There may be a good opportunity to buy with a bit of leverage as the crash continues. So now, if you feel it's appropriate to sell, go ahead. But I think we're going to start seeing buying opportunities emerging in the next 2 to 4 weeks. That's my guess. I can't predict the future. I'm not reading the tea leaves. I'm not using the I Ching to make my forecasts. I'm just estimating based off of the kinds of rapid declines we saw in 2008. There will probably be continuing to fall down the staircase a little bit throughout April and May. You won't catch the bottom if you buy necessarily in April, but I think over a 3 to 5 year holding period, this will represent a reasonable buying opportunity. Do I see credit cards the same way as being recession proof? No, credit cards are going to definitely be a little bit more vulnerable because I think a lot of people have got a lot of excess debt. Fighting and looting in Hamilton. Damn it. What's wrong with people? Okay. But using leverage to purchase dividend stocks and ETFs with monthly distribution that surpass the interest rate on the loan. That's a great idea, Haval. You might take some capital losses, but that's not necessarily a bad idea if you can generate enough yield from it. Interest rates are super low. If you wanted to try a more sophisticated strategy, for instance, you might go into a bond fund with some leverage because at the end of the day, your funding costs are going to be pretty cheap when they start slashing interest rates, and you might be able to earn a decent spread. I would expect corporate bonds are going to see their prices fall as the flight to quality takes hold, and we see a lot of move into government assets. Don't sell your home this year. I know nothing about buying a house, and I still rent. Whether you should sell your house, sell it to me for half price, maybe. Otherwise, I'm just going to buy a house in France. Can you suggest some good government bonds to consider investing into? Offhand, I don't buy individual bonds. If you buy an unhedged bond index, it's 70% government bonds anyways. The thing to look for is a bond fund with a high duration, which is a sensitivity of price to a change in interest rates. High duration is what you want if you're hoping to take advantage of that interest rate play this week. Are government bonds better than corporates? Yes, they are. Corporate bonds are going to fall. Any flight to quality triggers this sort of stuff on a regular basis, Sean. If our investments are managed by a bank, does it make sense to book an appointment and say, what do you recommend I do with my money right now? I'd recommend you not waste time booking an appointment and you just call them. People get sick. Don't put yourself out there if you don't have to right now. Anyways, so I hope this was sort of useful to people. I realized it was a bit of a chaotic mix of things that, it wasn't put together like a formal lecture. It just sort of rambled around to a number of different topics. Might be worth reviewing the video just to kind of have a look at it. So if those of you who recorded it want to post it somewhere, that's lovely. No problem at all. There's a lot of people in this meeting. I didn't expect so many. But anyways, I want to let you guys go because I know that the first BL class has a class, Sanjay's class, I believe, right now at 1 o'clock. So I'm going to sign off for those and say have a good day. But for those of you who are in the second BL class cohort, or those people who just joined because they were interested in it who don't have class, I can hang out for a little bit, take some more questions. We can chat about this stuff. But otherwise, for the Mark, thanks for setting this up. It's very cool of you. I hope people found it useful. And most importantly, don't panic. Look for opportunities. Keep a bit of a level head and stay safe.
Hey, Will, can you just make sure to end the meeting then when you sign off? Just so
yeah, I'll be the last person to end it, and it'll save the recording, I imagine, here. And I don't know how I'll distribute it, but we'll figure something out.
Okay, thanks. We can pull it down from the cloud.
Oh, cool. Awesome. So questions I can field for anybody now that sort of the people who have to run off to their other online class have hopefully done that. Let's see. Don't use Robinhood. Yeah, Robinhood's a cool piece of software at the end of the day, but right now I hear it's been malfunctioning every time the market drops, so I'd be cautious about it. Yeah, I personally like if you're trading volume, Interactive Brokers is great. Interactive Brokers used to charge us €1 a trade. It's how we managed our portfolio with Finance Association at Tilburg. It was nice and cheap. Did quite well for us. Oh, I think he means like trading large amounts. I found IB was pretty good for fills. The only thing I found that was weird about IB, and I'm not sure if they still do it, is that if you trade in any currency other than your home currency, they don't actually use the money in your account. They borrow that foreign currency, which means you pay interest on it, and then they buy stocks in that currency. So really importantly, if you have idle cash sitting in your IB account, do not leave it as cash. That's not what gets spent. So when you say buy Korean stocks with your IB account, they will borrow won and buy stuff in won for you. Your cash will continue to sit in your account. So make sure that it's earning some rate of interest. Put it in a bond fund or something like that. If I have a business account, you recommend an RRSP or TFSA? I'm not sure what you mean, Mohammed.
So I have my own incorporation. So I have a business account in which my salary comes, and I have my 13% HST, which is being paid to me by the business. So if I'm opening a trading account, so which one should I go for? Since I'm having a business account, so if so tax-free, tax saving wise, if I transfer it to TFSA, so I have to still pay tax on my business income. if I transfer it to RSP, then I don't have to pay tax. But then if I remove the profit out of RSP, then I have to pay tax for it. So which scenario would be better?
I'm confused about why you'd be paying taxes in your TFSA.
So since we are transferring, moving the funds from my business account to the TFSA,
Yeah.
at that time I have to pay taxes for it. So that is tax.
Oh, you mean like a capital gains tax?
Yeah.
Oh, yeah, of course, because it used to be an untaxed account and you're moving it to a tax-free account. In general, the choice between TFSA and RRSP, as far as I'm concerned, boils down to the need for liquidity. If you need the liquidity, put it in your TFSA. If you need the money anytime in the next 30 or 40 years, put it in your TFSA.
Okay.
So if it's to like build up money for down payments or to be able to like buy a house or anything like that, I would generally say your TFSA until it's full. RRSPs are nice if you have high income right now because you get a tax break for making contributions to it.
Okay. Thank you so much.
Yeah, the best honest thing, the best thing you can do in that sense, I'm not a tax specialist. I know a few tax tricks because it was important to being able to be good at investments. But if you've got sophisticated strategies or you've got complicated taxes, hit up an accountant is your best bet. I'm pretty sure that there will be people who have business backgrounds who are getting an MBA who also might be accountants. If you have trouble finding one, let me know.
Okay, thank you so much.
I gotcha.
Any recommendations for any specific bond fund ETFs, like ticker number?
Let me take a look. See if I can dig up for you. I normally use Vanguard funds because Vanguard's cheap on the management fees. But let me see if I can dig up something with long duration. Long duration bond ETF. I just put my keyboard on the other keyboard and I just realized that made a hell of a noise. So BlackRock's actually got something here, but I'm trying to figure out is if it's duration hedged really quick. It is specifically a iShares Core Long-Term Bond Index ETF. The symbol is XLB. I'm just gonna take a quick check to see whether it's hedged. Exposure, blah, 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 blah. Why don't they just tell me that? Maturity is at least 10 years. Well, that's a bit of a pain. Their fact sheet doesn't actually tell me if they've hedged it. Oh, there we go. Gotcha. Effective duration 16 years. That's what we care about. So yeah, I would take a look at XLB as an unhedged long-term bond index. It's got a mix of provincial and Canadian government debts. It also has a little bit of investment grade corporates. And it trades as an ETF. There are no options on it, I believe. You can put it in your RSP and you can probably trade it with leverage in your margin account. All right. So otherwise, it seems like, questions are calming down, stuff like that. Any final things I can address for people before I go make some lunch? No worries, man. If you got any other questions, you can hit me up on Facebook if you've got me there. Email me, of course. Reach out to me. I'm still in the 2018 and the 2019 Slack sections for the two courses. So reach out to me anytime. I don't sell anything. I don't charge anything. And as per the verbiage in the law, I don't offer financial advice. I can only offer financial information. I'm not licensed to be giving people advice on what to do with their money. So take it as not a formal recommendation from someone who you regard as a source of authority in finance. Take it more as things I can think about. Before making any big moves in your portfolio, you should probably talk to your licensed financial advisors, get their feedback on it. But that shouldn't stop you from thinking about it, because in some cases you may know more about finance than they do. Otherwise, have a good day, everybody. I got to get to my lunch, and yeah, talk soon. Take care.